Fiscal 2017 was one of the best years for the EU economy in the last decade, with synchronized economic growth through all European countries. The synchronized economic performance led annual GDP growth to 2.7%, the highest indicator since 2011. With positive performance over other economic metrics, such robust growth has created bright expectations towards continued economic expansion in 2018, with an estimated annual GDP performance at 2.3%. Positive economic momentum and rising inflation has allowed ECB officials to reduce the QE program of monthly bond purchases to €30 BLN per month, with plans to exit at the September 2018 meeting. Source: ECB quantitative easing QE timeline. These changes have led the single currency to rise, reaching a top rate of €1 United States dollar and 25 cents, a 19% increase from the 2017 low of 1.05. Such currency performance, along with protectionism movements on the world markets, put EU products in less competitive positions. This eventually created problems for corporate Europe, which depends on exports for 47% its incomes. Results were a decrease in production output with further negative consequences. Source: Composite PMI, US. This Eurozone that negatively affected GDP performance, which in May recorded its slowest growth in 18 months. Source: Future GDP growth implied by BlackRock GPS versus consensus estimates. National currency strengthening started to diminish ECB's efforts towards reaching its target inflation rate below, but close to, 2%. April core rate of price growth dropped to 0.7%, weakest in 13 months. Source: Euro area's Easter inflation blip gives ECB cause to stay wary. The above negative signs have created doubts over the expedience of the ECB's aim to finish its QE program at the September meeting. The program exit will significantly reduce liquidity on capital markets and will lead to further currency strengthening. This will make a rise in inflation uncertain and at the same time create the risk of deflation appearing, which would be harmful to GDP. In my opinion, under such circumstances it is questionable whether ECB Chairman Mario Draghi will pursue the September exit. This will create specific investment opportunities. The extension of the QE program will put pressure on debt markets by lowering its YTM. After the period of rising, European junk bonds index shows a 3.04% YTM. Source: ICE BOFAML Euro High Yield Index. Effective yield: 1-year government bonds are still in negative territory and 10Y is around 1%. Source: Euro yield curves. Daily data. In comparison with major European indexes, dividend yields, STOXX Europe 600 to 3.1% and Euro STOXX 50 to 3.4%. EU equities look more attractive for investments than fixed income assets. Currently, both indexes' dividend yields provide a higher passive income rate compared to junk bonds. Due to the earnings season results, we have the background for a rise. In aggregate, companies are reporting earnings that are 7.7% above estimates, which is above the 4% long-term, since 2011, average surprise factor. First quarter earnings are expected to increase 4.1% from Q1 2017. FY18 earnings are expected to increase 10.95% from FY17. Source: STOXX 600 earnings outlook, May 8, with following EPS growth contribution by country. Source: STOXX 600, Q4 2017 Y earnings growth rate estimates by country. The major EU major indexes show a lack overvaluation. Moreover, data indicates that there is a potential to rise, with dividend yields at 3.1% and 3.4% respectively, compared to S. Conclusion: the EU economy is exposed to the single currency strengthening given its large export incomes exposure in terms of GDP, 47%. But despite the recent GDP and PMI slowdowns, the 2018 GDP growth is expected to be in the range from 2% to 2.3% annually, higher than the average gauge in the decade. And PMI that still holds above 50, indicating strong corporate momentum. The recent inflation slowdown will put pressure on ECB board of directors, potentially resulting in a shifting of the QE exit, which will be very beneficial for the corporate sector because companies will continue to receive low-cost credit. A bond purchase program (QE) extension will lead to greater devaluation in the single currency. That, in combination with lower borrowing costs, will support already sustainable corporate and GDP growth. The QE continuation will create pressure on the YTM in the bond markets, which are still below the major indexes' dividend yields. Considering the current earnings season results, EU companies will be in a position to maintain higher dividend yields compared to bonds. This puts equities in a better position compared to debts, and as a result, it is possible to expect additional inflows into EU equities. The above leads me to treat EU equities as the better place for investments compared to bonds in 2018. Disclosure: we are long EU. I wrote this article myself, and it expresses my own opinions. I am not receiving compensation for it, other than from seeking alpha. I have no business relationship with any company whose stock is mentioned in this article.